So for now, the US economy is still growing and still growing well, but it isn't growing quite as fast as economists had anticipated. And if we are going to see a turn, then this might be the first step in that turn. So for now, it's very much the case that things haven't turned bad for the US economy at all, but they're certainly less good than they have been over the last 6 months.
This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance.
Welcome to the Converge Market Update, February 25th, an eventful close to the month. Stephen Dooley, great to have you back. Well, it's been 2 months now into the new year, almost 3, and we're starting to see a shift in some of the big themes that have dominated markets over the last 6 months. Have we reached a turning point here? Steve, what do you have to say for this?
Yeah, thanks for having me on again, Alex. Yes, there seems to be a bit of a shift in those 3 or 4 big themes that have really driven the market over the last 6 months or so. The Trump trade, the powerful performance of AI, the Magnificent Seven stocks, and particularly some of the outperformance of the US economy compared particularly to the European economy. So these themes, which have really dominated markets for the last 6 months, do seem to have put in a bit of a turn. I think, first of all, probably the most interesting factor we've seen over the last couple of weeks is that markets seem to be suffering from a bit of tariff fatigue. Trump's trade rhetoric and tariff developments very much still driving moves in markets, but we're not seeing these moves as being as large, as impactful, or perhaps even as persistent as we have seen. It looks like there's a bit of law of diminishing returns where after a month or a month and a half of tariff headlines, markets aren't as concerned, certainly in the short term, as they have been over the last 6 months. So partly I think that's because markets are getting used to the idea. Partly it's because we see a history of shifting positions. Tariffs are announced and then they're postponed 24 hours later. So for now, it seems like, particularly, I think one of the dominant themes have been markets reacting in shock to tariffs, just not occurring as much as what we have seen over the last 6 or 7 weeks.
Yeah. Obviously, the U.S. economy, it's been this sort of habitual outperformer over the last 3 years. But would you say the U.S. is slowing down or showing signs of slowing down at this point?
So absolutely. It's still performing well, but one of the measures we use to determine whether the economy is outperforming or underperforming is how economic data relates to expectations. And when you go through a period where economic data beats expectations, that's a sign of an economy growing faster than the market anticipated. And on the other hand, if we're missing expectations, that's a sign that the economy can still be growing well, but it's not growing quite as fast as economists might have expected. So that's the phase we're in at the moment in the US, where it's still growing well compared to other economies, but it's not growing quite as fast as markets or economists had anticipated. Before the weekend, housing, consumer services, data all surprised to the downside, particularly this drop in the University of Michigan consumer sentiment numbers was a bit of a concern. And overall, the data that we're seeing from the US isn't beating expectations as much as we thought. Now, that's clearly different to producing a negative read or being disappointing. So for now, the US economy is still growing and still growing well, but it isn't growing quite as fast as economists had anticipated. And if we are going to see a turn, then this might be the first step in that turn. So for now, it's very much the case that things haven't turned bad for the US economy at all, but they're certainly less good than they have been over the last 6 months.
Would you say that this slowdown has had any impact on markets?
Yes, so it's had a very specific impact on markets. Probably most notable has been in the US bond markets, with the US 10-year bond yield dropping from 4.63% down to 4.3% in just 2 weeks. Now, that's really a sign that markets are either worried about growth or they believe that the Federal Reserve needs to cut rates more than they expected. But really, a big drop in that US 10-year bond yield is normally a sign of a shift in expectations in growth. So such a big drop from 4.63% to 4.3% in just 2 weeks is a pretty notable shift. And that really ties into some of that data we were talking about previously that seems to be just starting to slow as well. Now, that's more of an economic tell. In terms of the more speculative parts of the market, they've also come off quite significantly as well. So, when we talk about speculative parts of the market, there's nowhere more speculative than the cryptocurrency markets. And Bitcoin's down from that peak we saw in mid-January of around 106,000 down to 88,000 over the last month. So, around about a 15% loss over the last month, which in cryptocurrency terms isn't a lot, but it's certainly something to make note of. Depends how leveraged you are, I guess. Now, in US shares, again, this is where the overall US share market is. So the S&P 500, which is the benchmark traditional part of the market, is down only 3.3% from the recent highs. But that so-called Magnificent Seven, Google, Apple, Tesla, that more technology part of the market, again, the more speculative part of the market, that's around 12.5% since mid-December. So as the US economy starts to slow, some of the more speculative parts of the market are starting to turn as well. So if there's anything we're going to watch over the next 2 weeks, it's really about how that US data plays out and how these more speculative parts of the global markets, particularly US markets, how they play out as well.
Yes, indeed. Well, that's what we're here for, right? Speculation. So perhaps even more surprising, what about Europe? Are they staging a comeback at this point?
Well, absolutely. And so when we were talking about the themes that have dominated markets over recent times shifting, this is another theme that had been quite persistent, that the European economy was in a very negative state. And again, this is how sometimes happens in markets. The momentum, the sentiment towards Europe had got so negative that from here, really, potentially the only way was up. And so that momentum, as in the US, has started to come off a little bit. In Europe, it started to rebound somewhat. So while we're seeing the US economic data slow, in contrast, we're starting to see European macroeconomic indicators suggest a bit of a stabilisation and perhaps even signs of recovery. Also, the euro is starting to pick up as well. So as the US economy slowed, we've seen the US dollar weaken. As the euro economy improves, we've started to see the euro improve as well. And so we've seen a bit of a more positive sounding sentiment from the European Central Bank, and that's also tying into expectations around the European economy as well. And then finally, reports of a potential peace agreement in Ukraine has also been more positive for the European area as well. So European economy doing a bit better, ECB sounding a bit more positive, and hopes for a settlement to some of the biggest geopolitical issues in the world around Ukraine is all suddenly seeing a bit more positivity towards Europe.
Really interesting developments for sure. So how does this translate into FX markets if folks are thinking about currencies, starting with the US dollar, as always?
Of course, it's we always kick off with the US dollar, but again, what we were talking about earlier about the US economy slowing has really impacted the US dollar. It's down about 3.5% from the peak a month ago, back in January. It's the lowest level for the year. So the US dollar's definitely been starting to weaken. And remember, again, talking about the big themes in markets that are starting to turn, the stronger US dollar has been one of the main themes in FX markets over the last 3 years. We're not necessarily calling an end to that US dollar strength by any means, but certainly over the last month or so, we have seen a significant turn in the US dollar, with it at the lowest point for the year. We've seen the euro up to 2-month highs, the British pound up towards 3-month highs. We've seen the Aussie dollar up towards 2-month highs. So the weaker US dollar is really playing out quite significantly in FX markets. So now with the US dollar weakening, the question is, well, what will drive the US dollar higher from here? We mentioned earlier that the news around tariffs isn't as impactful as we had previously seen. So that's not really helping the US dollar. This slowdown in the US economy means that the Feds might be more liable to cut interest rates. That can weigh on the US dollar as well. And then finally, if some of the US share market isn't doing as well as it has done recently, if markets start to think, well, maybe my opportunities are in Europe rather than the US, then that can always weigh on the US dollar as well. So US dollar's lower, and there are some major themes out there that make us wonder what can really be the driver of a rebound in the US dollar. That said, the US dollar has dominated for the last 3 years, so we can't call the end to the US dollar higher for now, but it's hard to see what's going to be the driver to push the US dollar higher in the current circumstances.
Sure, yeah. And what about the euro? Has that been helped by the improvement in the data you talked about earlier?
Yeah, absolutely. So the euro and the British pound have really been a couple of the best performing currencies over the last couple of weeks. And again, that US dollar's playing into it, but that improvement in the European growth forecasts are driving that as well. I mentioned earlier, particularly some of the comments around from the ECB saying that they might need to rethink any further rate cuts. That's helping the euro as well. So for now, we're seeing the euro sort of bounce up towards sort of key technical levels around 105. That's been a bit of a short-term cap for the euro. The British pound has reached a bit of a short-term cap up around 127, and the Australian dollar has reached a bit of a short-term cap as well, up around 64 cents. So again, when we talked about what we'll be watching over the next couple of weeks, how does the US economy play out? How do those speculative parts of the financial markets play out? But in FX markets, it's really about the US dollar. What are going to be the triggers for the US dollar to rebound? And if it doesn't, can these currency pairs, the euro, the British pound, and the Aussie dollar, all break above these technical resistance levels? As I mentioned, 64 on the Aussie dollar, 105 on the euro, and 127 on the British pound, really key technical levels to watch. So really, we're seeing things turn in real time at the moment in terms of those dominant themes. And over the next 2 weeks, those dominant themes and those technical levels in those key FX markets are really going to tell the story about what happens next for at least the first part of this year.
Great stuff, Steve. As always, thank you. We'll check in again in a couple weeks. Have a great one.
Thanks for having me on, Alex.